Hello everyone, my name is John Locke and I'd like to welcome you to The Winning Trade. But first, the required disclaimer. This presentation is given for educational purposes only. We're not broker-dealers or financial advisors and we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial, and also make sure that you are aware of all your risks prior to placing any trades. Also note that we are using hypothetical computer simulated trades and or results in the presentation today. They are believed to be as accurately represented as possible, but keep in mind that live results can vary from simulated results for many, many different reasons. If this is your first experience with us, my name is John Locke. I'm a trading performance and success coach with Locke in Your Success LLC, and myself and my team are here to help traders win in the market and in life as well. And today I'm here to guide you into the realm of high probability income trading. Now in a moment, not now, but in a moment, we're going to be going over the winning trade. But before we do, let me quickly explain what we mean by an income or high probability trading strategy. An income strategy is where we put ourselves in a position to generate profits through the passage of time rather than depending solely on price movement to go in the right direction, meaning we can often make money whether the price goes up, down, or sideways. Now this doesn't mean we're going to win all the time, but it does mean that the probabilities of us winning are much higher than they otherwise might be. Now, when you find that you want more information as you're following along, simply contact us at lockingyoursuccess.com or ask a question in the comments of this video, and we can direct you to where you can find more information. The winning trade we're looking at today is from our X4 series of trades, and it's called the X4 version 14, or simply V14 for short. This is a simple, very conservative broken wing butterfly strategy that we trade on the SPX. The position lasts about 60 days and it requires a minimum capital of $2,250 to trade. For the example size we're going to be using today, we're going to have a planned capital of 10 times that amount, $22,500, and we're going to be using what we call a 10 lot, or we're going to be using 10 contracts or 10 butterflies. As far as risk management, the V14 has a high profit target number of 11.1%. And if certain things happen in the trade, we're going to reduce that profit target to 6.7%. And the exit loss trigger is going to be 11.1% as well. In this particular trade, that equates to a profit target of $2,500 and a reduced profit target of $1,500 if that happens to be triggered. And we're going to have an exit loss trigger of $2,500. So let's take a look at the position. For those of you who may be new to us, this is called a price matrix. And down this side lists the strike prices of our options. This here shows us our position. And this over here is a risk graph. The price of the asset goes from left to right. The price or profit and loss in the position goes up and down here on the right. We have our expiration graph, which is what the position is theoretically worth at expiration. And we have what's called our T+0 line, which is this curved line with the red dot on it. And that is the estimated value of our position today and any given price point on the SPX. This particular position here is what is referred to as a broken wing butterfly. If we look at our date, it's up here, and it's Friday, January 31st. This is 77 days to expiration for our April 17th, 2020 expiration options. If we look down on the bottom here, it tells us what our profit and loss is. It gives us our Greek numbers for those who know what that is. Delta is here of 8.67. We have a gamma of minus 0.04. We have a theta of minus 22.42, and we have a vega of minus 15.76. This is our entry position. We do what's called a broken wing butterfly, and when we enter an X4 version 14, we put the long strikes at approximately what the asset price is. In this case, the asset price is at 32.20, and we're using that for a long strike. We go 40 points down. We do a 31.80 in this case. We sell 20 of those, and then we go 60 points from there, and we look at our 31.20s and we buy 10 of those. And when we do that, depending on what the implied volatility is, we're going to have a certain delta number. In this case, if I just do the butterfly, it gives me a delta down here of what I'm modeling at 17.81. In this position, we don't want our entry delta to be any more than a positive 9. So that being the case, what we're going to do here is we're going to add a put to bring that down. And in this case here, if I buy a put that has minus 9 delta, that is going to give us under 9 delta for our composite position. Now this does throw us negative theta, but one of the things about analytical models is the numbers you see here for delta, gamma, theta, they're just estimations the model throws out. They're not always accurate. In other words, they're a composite number, and they don't always represent what the position is going to do. So we're not going to worry about the fact that we're posting a negative theta number here. Over time, if the price doesn't move, this theta is going to turn positive anyway. So this is what our starting position looks like. Now, for those of you who might not know what this trade went through, is this trade did go through the recent market down move we had at the end of February. So for those of you who don't know, the last week in February, the last full week, this week here, the 24th through the 28th, we had one of the largest down moves that we've ever had in that time period, and from a point value standpoint. So this is going to go through some pretty rough times, and it's going to go through a down move. So it's a really interesting trade to review. So let's look at how this does. So right now it's Friday, January 31st. If we go to our next adjustment or our first adjustment, we go all the way until February 25th. Let's go 2 or 3 days before this. Let's go to February 21st. So we're in this trade for almost a month. And during that time, the trade didn't require any adjustments. It's just been sitting here, and the market had gone up. As you can see, this Friday, the SPX is down substantially. So the trade's been sitting here, and the profit and loss actually went up to somewhere around getting close to our reduced profit target number, but never really getting anywhere near our actual high profit target number, which would be the number we'd be looking for at this particular time. So that being the case, there's really nothing to do here. So let's just go to the next day. We get a 96-point down move in the SPX. That is a huge, huge move. If you take a look at our price chart here, this is what was happening, right? We got in the trade, I guess, on the 31st of January, which would have been right around here, and then the market just kind of continued to climb, and then all of a sudden we get this decent sized down move, and now we get this really, really hard down move. And so far, no adjustments into the position. We're up about $59, and here is what our position looks like. So this in itself was a really, really huge down move. But what happened the next day was even more. So if we go to the 25th here, we put another 101 point down move on top of that. That's a very, very big move. If we take a look at our price chart here, you can see we've gone all the way from about 33.86 all the way down to about 31.24. That's like 150 points. That's really, really large move in that amount of time. Now, if we look at our position here, we're back outside the tent. And by the tent, I mean outside the expiration graph here. Now, this position was supposed to be adjusted back when we hit our short strikes of about, let's see, our short strikes here are at 31.80. So when the price was under 31.80, then we're generally going to adjust it back. Now, we only check these positions once a day towards the end of the day. So when we get a really huge move like this, a lot of times we will drastically exceed our adjustment point, and that's pretty much what happened here. We are, like I said, I'm just going to widen this out a little bit. Our adjustment point's way up here at 31.80. Asset price is all the way down to 31.24. So really, really big move there. What we're going to do in the event that this happens is we remove our position, and we do a reset to entry position is pretty much what we call it. So I'm going to take this 31.80 off, and we're going to move all the way down to 3,080. So we're putting our long strike at the money, which is 31.20, right? We have a 31.24 asset price, so 31.20 is the closest strike to the money. We're going to go 40 points down, put our short strikes in. We're going to go 60 points down from there and put our long strikes in at 3,020. If we do that and we don't have a call, we don't have a put in place here, if we just look at the butterfly, we're positive 18 delta. So we're going to come in, we're going to get our delta down under 9. In this case, we're doing a 10 delta put, and that's going to give us this position here where we are, again, in negative theta. We are still positive delta, about positive 8. Our vega is slightly positive at this point, and that's because we have so much time premium in this put because the market's been moving so fast. The market's literally freaking out here. If we go to the following day, Wednesday we had basically a flat day. One of the problems about being really positive vega and negative theta at the same time when the market's really screaming is if the market slows down, you get a drop, what we call a drop in the T plus 0 line. That's what happened here. We went from, I think, 800 negative to, we've almost doubled that number to 1600 negative. So that does tend to happen sometimes when we have put protection and the market stops. We're still well within our maximum loss number. Our maximum loss number here is minus 2,500. And we are still far from an adjustment point. Our adjustment point actually doesn't come in play till around 3,080. So we just let this go overnight. We go to the following day. And we end up getting a 91 point down move in the SPX. Very, very big move. We're drawn down a little more. Okay, we're at about 1732. We've drastically exceeded our short strikes here. Once again, so we are due for a rollback. So we're currently have our short strikes at 3,080, and we're going to bring these down. We're going to put our long strike. It looks like about 3,020 here. Let's see which strike I actually chose. Yep, we put our long strikes at 3,020, right? We just reset to entry position. Long strikes at 3,020 and short strikes at 29.80, 40 points under that, and then 60 points under that at 29.20. We are adding our long strikes. If we did not have a put in place, we would be 18 positive delta. We want to be under 9. So we add a put, in this case a 10 delta put, and that gives us this position here. We're once again negative theta, which is okay. We're actually still positive vega at this point. And here is what our position looks like. Look at the price move here. This is an insane price move. Like I said, for this time period, this is the biggest point drop move we've ever had in the SPX. If we go to the following day, we wait till the end of the day, as per usual. We get another large down move in the SPX. And this time, what happened is we got a volatility spike, and this is usually accompanies a capitulation down in the market. We had a really huge jump in volatility on Friday, and this really helped the price of this put back here. And with that move, we ended up being up $1,465 after this 82-point move. But that said, we are certainly due for an adjustment. We're way past an adjustment point. So we want to come in here and we want to do the same thing. We want to take the position off and reset it to entry position. We want to go to, let's see, it looks like we're going to be at probably 2,900 for our long strikes. Let me see if I guessed correctly. We come down here, we put our longs at 2,900. We go down 10, 20, 30, 40. We put our short strikes in there, and we go 10, 20, 30, 40, 50, 60. Put our long strikes in. If we didn't have any put protection on that position, we would be positive 15 delta. So we want to bring that down. So in this case, we bring it down under 9 by buying a 2180 put. And this is our new position. From here, we go to the very next trading day, right? This takes us over the weekend. And what ends up happening is we end up getting a very, very large up move in the market. In fact, this day here was, I believe, the largest up move that we've ever seen from a point value in the SPX. So as you can see, the market's really, really moving around here. We're near our profit target. We're at our profit target is $2,500 in the trade. We're at $24.98. The reality is, it would probably be a good idea to take this trade off. You go 5 minutes before, it's 27.13. The prices tend to fluctuate in this type of environment. You go afterwards, it's posting up at 3,000. So definitely could have possibly taken it off this day at or near enough to our profit target to do that. And I think some people probably would have done that. But that's our second opportunity to get out of the trade. If we go to Thursday, we actually get a down move, but with that down move of 68 points, we are still over our profit target number. We're still at 26.83. That being the case, this is a good solid number, good solid profit target number to warrant taking this, taking the profits and moving on. So we would close the trade here, and if I enter my closing model trades here, that gives us a theoretical profit here of $2,642. That would be in, let's see, 77 minus 45 is going to be 32 days. So that's a profit of $2,642 in 32 days in a market that had one of its largest point down moves in history and one of its largest up point moves in history in a very short period of time. That is what I call a nice trade. The X4 version 14. This episode's winning trade. If you like what you see, I encourage you to join us and discover how you too can follow along with this and other great strategies as they unfold during our weekly options trading for income webinars. And we can also learn about upcoming winning trade presentations as well as our trading success blueprint. And perhaps best of all, you can get information about our free trading performance podcast, where you can learn to become a much more effective trader regardless of the type of trading you do. If you have any questions or comments or anything you'd like to see on the next winning trade, we'd love to hear from you. Simply comment on this video below so we can get those answered for you. And we would also encourage you to come on over to thewinningtrade.com, where you can find past episodes of The Winning Trade, as well as a lot of other fantastic bonus information on how you too can profit through income trading. And please remember to subscribe and comment on our YouTube channel, where I can personally answer any questions you may have. Thank you, and we'll see you on the next Winning Trade.